It wasn't a manufacturing bottleneck. It wasn't a sudden spike in solar panel production. It wasn't even a coordinated squeeze by retail traders. It was the inevitable reversion of a paper derivative market to the unforgiving laws of physical scarcity. When the price of silver breaches $85 an ounce, when the United States Mint announces it can no longer source the blanks required to strike sovereign coinage, when the premiums on physical bars detach entirely from the spot price displayed on terminal screens, you are witnessing a specific historical phenomenon. It is not a bull market. It is a currency crisis disguised as a commodity boom. The pattern is unmistakable. The arithmetic is merciless. History shows us that when a fiat currency reaches the end of its debt expansion cycle, the paper claims on real assets begin to exceed the available physical inventory by orders of magnitude. The market realizes that the vault is empty. The disconnect creates a vacuum. Prices explode upward not because the metal has changed, but because the currency measuring it is dying. We have seen this sequence play out before. It happens when empires overextend. It happens when the cost of maintaining the state exceeds the tax base. It happens when the only solution left is to print the difference. We saw it in the Spanish Empire during the price revolution. We saw it in the Weimar Republic during the flight from the mark. We saw it in the late 1970s during the dollar's crisis of confidence in current data. Suggests we are entering the fourth great iteration of this cycle. The mechanism is always the same. The public ignores the metal for decades. The banks suppress the price to maintain confidence in the currency. Then the physical shortages begin. The mints run dry. The paper market breaks, and the price finds its true equilibrium. The history of this pattern is written in ledger entries and bankruptcy decrees. To understand why a shortage at the U.S. Mint signals a systemic fracture, we must look first to the Spanish Empire of the 16th and 17th centuries. This was the era of the price revolution, a period that offers a haunting parallel to our modern monetary dysfunction. The Spanish crown under the Habsburgs controlled the greatest source of physical money the world had ever seen, the silver mountain of Potosi in present-day Bolivia. From 1545 onward, the mines of Potosi flooded the Spanish treasury with silver pieces of 8. One might assume that owning the world's supply of money would make a nation permanently wealthy. It did the opposite. The Spanish crown used this silver not to build domestic industry, but to finance endless wars in the Netherlands, France, and against the Ottoman Empire. They treated the silver as a credit card with no limit, but the physical metal had to be mined, minted, and shipped. The crown's spending, however, was immediate. They began to issue debt juros backed by future silver shipments. They spent the silver before it arrived. By the reign of Philip II, the influx of silver had caused prices across Europe to rise by 400%. This was the price revolution. The abundance of money without a matching increase in goods destroyed the purchasing power of the average Spaniard. A carpenter in Castile in 1590 found that his wages paid in silver bought less food than his grandfather's wages had 50 years prior, but the true crisis began when the silver shipments slowed. As the mines became harder to work and the costs of empire mounted, the Spanish crown resorted to the classic maneuver of a dying currency debasement. They introduced vellon copper coinage to replace the silver that had flowed out of the country to pay foreign bankers. The silver disappeared. Gresham's law took hold. Bad money drove out good. The silver pieces of 8 were hoarded, melted down, or exported, leaving the domestic economy to function on worthless copper tokens. In 1640, under Philip IV, the situation became critical. The crown, desperate for physical metal to pay its troops, seized the private silver bullion arriving from the Indies that belonged to private merchants. They converted it into government debt that would never be repaid. The incentive was survival. The risk was total loss of confidence. The result was the collapse of Seville as a financial center. The mints could not produce enough reliable coin because the government had consumed the feedstock. The parallels to a modern mint running dry are exact. When the sovereign consumes the supply, the public is left with paper promises. Just like the Spanish Empire, the Weimar Republic in Germany provides a brutal lesson in what happens when the link between paper and physical reality snaps. The year is 1923. The location is Berlin. The German government, burdened by the unpayable war reparations of the Treaty of Versailles, had turned to the printing press. But the phenomenon regarding silver in this period is often overlooked. Before the hyperinflation reached its terminal velocity, silver coins were common in Germany. The mark was originally defined as a weight of silver 2 As the printing presses roared to life to pay striking workers in the Ruhr, the paper price of silver began to detach from the face value of the coins. A 5-mark silver coin contained silver that was suddenly worth 50 paper marks, then 500, then 5,000. The population, sensing the destruction of the paper currency, did not wait for an official announcement. They drained the circulation. Silver coins vanished into mattresses, floorboards, and garden burials. The mints could not replenish them because the cost of the raw silver exceeded the face value of the coins they were striking. The government was forced to issue base metal tokens and eventually pure paper notes with higher and higher denominations. We see here the specific mechanic of the mint run. It is not a logistical failure, it is a price signal. When the Weimar government could no longer source silver to mint coins, it was because silver did exist. It was because the paper currency was no longer accepted in exchange for the metal. The breakdown happened in the spot market. Farmers refused to sell produce for paper, they demanded hard assets. There is a documented account of a university professor in Leipzig who in late 1923 used a small stash of family silver cutlery and old coins to purchase a plot of land that just 10 years prior would have cost a lifetime of savings. The paper price of the land was trillions of marks. The silver price was constant. The volatility was entirely on the side of the fiat currency. When the paper market breaks, the holder of physical metal dictates the terms of trade, just like the Weimar collapse. The silver crisis of 1979 and 1980 demonstrates the violence of a paper market squeeze, but this time in the context of the modern US dollar. The narrative often focuses on the Hunt brothers and their attempt to corner the market. This is a distraction from the structural reality. The Hunt brothers were merely the largest actors acting on a rational incentive. The dollar was losing purchasing power at a double-digit rate. In January 1980, silver hit $50 an ounce. Adjusted for inflation, that price is significantly higher today, but look at the mechanics of the mints and the industrial users during that spike. The United States government had already removed silver from its coinage in 1964 and 1965, anticipating exactly this kind of discrepancy. By 1980, people were queuing around the block at refineries to melt down grandmother's tea sets. The panic was driven by a loss of faith in the Federal Reserve's ability to control inflation. The COMEX, the paper market for silver, faced a near-death experience. The amount of paper silver sold contracts promising delivery vastly exceeded the physical bars available in the warehouses. The exchange changed the rules. They raised margin requirements to 100%. They limited buying to liquidation only. They forced the price down by altering the structure of the market because the physical delivery mechanism was days away from default. The lesson from 1980 is that the paper market exists to manage price, not to deliver metal. When the demand for physical metal overwhelms the available supply, the paper price becomes a fiction. The official price might be suppressed, but you cannot buy metal at that price. The premiums explode. This is exactly what we see when the U.S. Mint announces it cannot source silver blanks. The spot price says one thing, reality says out of stock. The pattern repeats in 7 distinct stages. Stage 1 is fiscal dominance. The government's debt load becomes so large that it can no longer be serviced by taxation. The central bank is forced to keep interest rates below the rate of inflation to burn away the real value of the debt. This creates a negative real yield for savers. Stage 2 is the awakening. Smart capital realizes that holding government bonds is a guaranteed loss in purchasing power. Institutional money begins to quietly rotate into tangible assets, land, commodities, art, and precious metals. This is the accumulation phase, often done off-market to avoid spiking the price. Stage 3 is the paper expansion. To mask the flight from currency, financial institutions expand the supply of paper derivatives. They sell unallocated gold and silver. They create ETFs that track price but offer no redemption rights. This suppresses the headline price while physical inventory is drained from the vaults. Stage 4 is the supply shock. This is the stage where the physical reality collides with the paper fiction. Mines face declining or grades 3 energy costs to extract metal rise. Sovereign mints bound by bureaucratic procurement rules fail to secure adequate supply at the suppressed paper price. Shortages appear at the retail level. Stage 5 is the bifurcation. The market splits in two. There is a paper price on the screen which remains managed and a street price for actual physical metal which carries a premium of 30, 40, or 50%. The U.S. Mint running dry is the hallmark of this stage. The official source cannot supply at the official price. Stage 6 is the delivery failure. A major exchange or bullion bank declares force majeure. They settle contracts in cash rather than metal. They change the rulebook. This destroys faith in the paper price entirely. Panic buying shifts from speculation to preservation. Stage 7 is the revaluation. The currency is either reformed, reset, or repegged. The price of the metal is allowed to rise to a level that clears the market, a price high enough to incentivize holders to sell. In historical terms, this is often an overnight gap up of hundreds of %. Just like the bifurcation stage of the past, current data suggest we are deep in stage 5. The headline U.S. Mint runs dry, the signal systemic stress. When the United States Mint announces that it is halting production of silver eagles due to an inability to source silver planchets, we must analyze the incentives. The Mint is required by law to meet public demand. If they stop, it is not a choice, it is a physical constraint. The supply chain for silver is rigid. It takes years to bring a new mine online. It takes months to refine door bars into investment-grade blanks, but demand can double overnight. We are seeing a convergence of 3 distinct demand vectors. First, industrial use and green energy technology is consuming over 20% of annual supply. Solar panels do not work without silver. 4. Second, sovereign buying nations like China, India, and Russia accumulating strategic reserves. 5. Third, retail investment demand driven by inflation fears. The paper market on the COMEX is leveraged hundreds to 1. For every ounce of registered physical silver in the vaults, there are hundreds of ounces of paper claims traded. Under normal conditions, this works because nobody asks for delivery. But when the price hits $85, it signals that the confidence game is ending. The incentive for a contract holder is no longer to take cash profit, but to take the metal before it disappears. Skeptics will argue that higher prices will simply bring more supply online. They point to the vast amount of above-ground silver in jewelry and silverware. This is the standard economic rebuttal. However, it ignores the energy cliff. Mining requires diesel. 6. Refining requires electricity. 7. As inflation drives up the cost of energy, the break-even price for mining silver rises. Furthermore, much of the easy-to-access silver has already been mined. We are digging deeper for lower grades. The supply elasticity is not what it was in 1980. The endgame approaches in a fixed order, controlled decline, chaotic collapse, and, finally, reset and restructure. In a controlled decline, the authorities attempt to manage the rise of silver. They will introduce capital controls or windfall profits. Taxes on commodities. We saw this in the United States in the 1930s with gold. They may restrict the sale of bullion to the public or mandate that all transactions be reported. The goal is to keep the population in the fiat system while the currency devalues. If the controlled decline fails, we enter chaotic collapse. This is the melt-up. The paper market freezes. The COMEX declares a liquidation-only event. The spread between paper and physical becomes infinite. You simply cannot buy metal at any price. Supply chains for electronics and solar panels seize up because industrial users cannot source raw material. This is the 1923 Weimar scenario. Finally, the reset. To restore confidence, the monetary authorities must anchor the currency to something tangible or issue a new currency entirely. At this point, the holder of physical silver possesses one of the few assets that bridges the gap between the old system and the new. The price in the new currency is irrelevant. What matters is that the metal represents a claim on real value when paper claims have been extinguished. The only variable is timing and pain. Subscribe to this channel. Do not rely on the paper price to tell you the value of your labor. Educate yourself on the difference between allocated and unallocated storage. Watch the premiums, not the spot price. The mints are telling you everything you need to know.